This is Kyrill with Centerfin Capital, and this is our collective weekly for the week ending September 27th, 2024. As always, we like to highlight a handful of things that we thought were interesting during the week. And this week, we will discuss China, which is probably the biggest news of the week. China launched a massive stimulus package that's both fiscal and monetary. And we will go through what we think that means and why that was somewhat of a surprise to the market. Next, we will talk about the housing market. The housing market, as we all know, has been in somewhat rough shape because of interest rates being higher and mortgage rates being higher. And as rates have come down, as the Fed has cut rates, that is showing some signs of thawing. And we think that's very important because it's a big part of the economy and it's important to people's lives. Starting with China, to take a quick step back, China has been very late coming out of the COVID pandemic. So they were very restrictive on COVID restrictions relative to the rest of the world. So they held very tight restrictions on the economy and their people through the end of 2022. And it was largely tied to Xi Jinping seeking a third term, which he was in the process of seeking during 2022. Once he secured that, they started to open up the country. And everybody expected that when China opens up the country in 2023, that would flow through to the global economy, and that would be, that would provide tailwinds to the global economy. And that hasn't really played out. China's economic activity has been much lower than expected. They're still growing. However, they're not growing at the rates they need to be, or at least at the rates that they have grown historically, and certainly not at the rates where the government wants it. And they've been very reticent to start any kind of stimulus packages. There's been talks about it over the last couple of years, but there's been very little that's actually been done. And as China being one of the biggest economies in the world, if it's not participating in global growth, that's going to serve as a headwind to the global economy. And this week, the Chinese government announced a massive stimulus package. And we think the timing of this is really tied to the Federal Reserve's cut in interest rates. Because the yuan, the Chinese currency, is pegged to the US dollar, they couldn't really launch a stimulus package without the US Federal Reserve lowering interest rates. And that's because they don't want their currency to weaken versus the dollar because it's tied to the dollar. And so as the Federal Reserve has brought in interest rates, that gave them the leeway to be able to launch a stimulus. And so the stimulus is pretty massive. And we'll go through these in some detail, but the details are obviously not as important as what the signal is. They're cutting the reserve ratio, which is a kind of a very important financial sector kind of adjustment where the banks are allowed to lend more. And so that's said to be providing $1 trillion of yuan into the economy. They're also announcing a support of the real estate sector by lowering interest rates specific to real estate. They're basically cutting everybody's mortgages. And as you probably are aware, in China, most people's wealth is tied up in real estate. And that's going to give people a little bit of an extra support. They're also putting together an $800 billion yuan market stabilization package, which basically is going to spur buybacks in the stock market, something they've never done before. So these are all very aggressive measures that are both fiscal and monetary that really took the market by surprise because, as we said, the Chinese economy has had a hard time recovering and the Chinese government has not really done anything about it until now. Obviously, there's folks that have talked about it, but most people were taken by surprise in these actions. That's meant that Chinese equities have shot up. The local markets were up anywhere from 5 to 10%, and there were some individual stocks, particularly internet companies traded in the US, that were trading at very cheap valuations that traded up by 10 and 20% on this news. This was obviously a very good development for the overall global economy, as China is a big part of the global economy. The other thing that we think is notable, but maybe not followed by most, but there's a very, very good investor, David Tepper, who was on TV just this week talking about it. And basically, in his mind, that gave him the green light to buy Chinese equities and buy emerging markets because this is something that, basically provides a massive tailwind to that part of the world. It's a very big development. The world has been waiting to see how China recovers from COVID, and it's 2024, and they've yet to fully recover. But the stocks in China are very cheap. They trade at single-digit multiples relative to 20-digit multiples in the US. And so this will potentially provide a tailwind to Chinese stocks. And more importantly, it will provide a benefit to the consumer in China, which, as you all know, has become more important globally than just locally in China. So probably the biggest news of the week and maybe the biggest news in the last couple of months. Next, we wanted to touch on the housing market. As the Fed went on in their most aggressive interest rate hiking cycle in 2022, the housing market has been frozen. The reason being is that most people, when they buy homes or houses, they don't buy them based on how much they're worth. They buy them based on the mortgage payment that they can afford, the total mortgage payment that they can afford. And as interest rates have gone up, that's meant the interest portion of that mortgage payment, which in the beginning is the biggest portion of that mortgage payment, has gone up significantly. So it's made housing unaffordable. It's also made sellers less likely to put their houses on the market because presumably if they were to sell their home, they would need to buy something else. And with, again, mortgage rates higher, they wouldn't be able to buy the same value house as they previously had. And so people were locked into their houses because they locked in mortgages in 2021 and before at very low rates, and not a lot of inventory was moving. Now, as we've discussed before, the Federal Reserve only cut interest rates last week, but the market has been pricing in these cuts for quite some time. And mortgage rates are not based off the Federal Reserve rate. It's actually based off the 10-year Treasury, which has moved down by 100 basis points since the second quarter of this year. And not surprisingly, so have mortgage rates. And so mortgage rates peaked at around 7.8%, just under 8% for the 30-year fixed. Earlier this year, they were at just over 7%, and today they're about 6.1, 6.2%. So they've come down pretty significantly, which means that the affordability of housing, even though the values of houses have continued to go up, the affordability based on the mortgage payment has become better. And so we looked into what some of the realtors are saying about this. And so Redfin, which is a big real estate company, said that mortgage demand surged by 70% in the last week, and that they have a home buyer demand index that was up 7% from last month. And the mortgage payment, the median mortgage payment actually decreased 4.4% year over year. This is the largest decline in over 4 years. And at the same time, as we said before, sellers have not been putting their houses on the market because they were not able to replace their shelter, so to speak. New listings have risen by 7.6% just in the last week, which basically shows you that people have started to put their homes on the market. So hopefully this is a thawing in the housing market, which is important for the economy. It's important for people to be able to move in and out of homes. And we think it's obviously a step in the right direction for the economy. The thing to keep in mind, though, is that even though the Fed cut rates and has signaled that they would cut rates even more, does not necessarily mean that mortgage rates will come down significantly to where they are today, because again, the mortgage rate is not based on the Fed funds rate. It's based on the 10-year rate, which has already come down ahead of the Fed funds rate. And it's actually up a little since the Fed cut interest rates. And the mortgage rate was priced off of that. Unless the 10-year rate continues to come down significantly, mortgage rates might not come down that much from here. But still, at 6% versus almost 8%, it makes housing much more affordable. And so hopefully that spurs some activity in the housing market as we head into the fall here. That's all we had for you guys today. Busy week, but those were really two of the things we wanted to highlight. As always, if you have any questions or comments, just drop them in the comment section below, and we will see you next week.